Afternoon, just off from Lunchtime Live with Susan Keogh today. Ciara Kelly is off on her holidays or something, I think. So we took all your questions on air. The ones we haven't got to on air, we're going with now. So let's jump into them straight away.
Okay, so what does approval in principle mean when it comes to a mortgage?
Approval in principle is not worth the paper it's written on, really, to be honest with you. Basically what it is, it's a piece of paper often, or sometimes an email, that the bank sends to you, that you walked into them, or you got your documents together, you gave them all your documents, they've looked over them, they've said, yeah, if everything you've said here is true, then we will give you an approval in principle. So the idea being that, yeah, it looks like we're good to give you a mortgage. The reality is until you have what's called a loan offer, the approval in principle is not legally binding. It gives you a good indication, and sometimes if you're bidding on a house, they'll look for the approval in principle because it shows you've gone through the process and at least a bank is willing to give you money. They haven't given you it or haven't legally obliged to give it to you yet, but they're willing to give you the money. So it's a useful document in that it gives you a thumbs up, but beyond that, it has no legal standing. So just be careful about it. And anyway, your solicitor will protect you with this stuff. In simple terms, approval in principle is the stage before loan offer. Loan offer only comes when you've found a house, you've got it valued, and the bank have ticked all the boxes to say, yeah, we're good to give this person the money. Then they send you the loan offer, and when you get the loan offer, then it's legally binding.
Okay, so this comes in from Sarah. So she wants to know where's the best place to invest children allowance so it won't be used for at least 10 years.
Okay, so 10 years means it's 5 years plus, which means it's not a bank account and it's not a credit union and it's not on Plus that you're going to save it in. You're going to save it in a 60-40 portfolio. I actually think we should do something on 60-40 portfolios at some stage. We'll put a little video together of exactly what it is. It means you're going to take a little bit of risk, but the risk will be diluted with two things in your case. The first thing is time. So the longer you invest in a 60-40 portfolio, which is 60% in shares, big companies of the world, and just to give you an idea, when I put a 60-40 portfolio together for a client, we will have about 13,500 companies that we're invested in. That's really, really well spread out. And that dilutes the risk. The length of time you want to invest for, which is 10 years, significantly dilutes the risk. But the last thing that dilutes the risk is the fact that you're going to put the money in on a month-to-month basis. Now, let's just imagine that for a second. If you are invested in shares, share prices go up and down all the time, but actually they go up and down, but they're on an upward trend all the time. So when you buy in on a month-to-month basis, you buy some shares here, some shares here, some shares here, and the share price is different. And what happens is you get an average share price over the length of your investment. Now that's a significant dilution of the risk that you're taking. And just to put that in perspective, some people would have invested in SSIAs, and they might remember the SSIA. The last SSIA was sold in May 2002. And if you use that money and you invested it in the Euro Stoxx 50, which is the top 50 companies in Europe for the next 5 years, the Euro Stoxx 50 started here. The top 50 companies, their share price was here at the end of May 2002, and 5 years later, it was 20% down. So you would have lost 20%. So if you had have put in 100 grand, it would have been worth 80 grand if you put a lump sum in at the start and took it out at the end. Because you paid in with the SSIAs every month, you put your money in and you got different prices all the way along in the different months. And actually what happened was, even though that point was 20% down, what actually happened was, if you put the maximum in, you put 15 grand in, the government put a 3,000 top up on it, and you would have come away with about 22,000 euro. Even though the stock market was down, it's because of your average share price that you bought in at. So you have three reasons why you shouldn't be scared of that risk. It's the length of time, the fact that it's a regular premium, and the average costing. So go for it. Get a bit of advice though.
Okay, so this comes in from Sinead. So what's the best place to get financial advice when you don't have money to invest but you want to plan for pension and a mortgage?
So there's lots of advisors out there that will talk to you and they will work off the basis of a commission. So people talk about commissions sometimes and they say commissions are bad and they're evil and we shouldn't have them. The reality is that there are certain people out there who need advice and can't afford to pay a fee for an advice, and that commission structure works for them, because what it means is that they take out products and those products pay the advisor a commission on them. I don't have a problem with commissions. I have a problem with transparency. What you need is an advisor who's going to be extremely transparent with you around how much they're getting paid and by who. There are advisors out there who are willing to work with you on the basis that when the conversation's over, there's going to be product that needs to be taken out and they'll get paid on those products. The only caveat for you there is that you now know, engaging with these people, if they don't sell you something, they're not going to get paid. So therefore, you have to wonder yourself, and this then comes down to trust. It comes down to how you feel about the person and have they got your best interests at heart. And to be fair, most of them do. So just try and get someone who you can be referred to. You can do this in the banks. You can walk into the banks. There's a further complication in the banks is in that if they're not charging you a fee, they have to get commissions and they can only sell you their own products. Now, I'm independent, therefore I deal with all the different life companies and investment houses out there, and some of the banks don't. They only deal with their own products. So you have to be careful about that. But ultimately, try and get someone, a friend of yours, a relative, who has dealt with somebody, and just look at what the fees are up front. If there are no fees, what are the commissions? How do they get paid? How are they going to keep food on their own table? And once you're comfortable, that's what you should do. There's no free advice out there. Somebody has to pay for it. I seen a tweet earlier on by somebody that said free advice is very expensive. So just be careful on that one. But commissions aren't the devil. Don't be afraid of them either.
Okay, so I need to access money for holidays over the next couple of weeks, about $1,500. Is it better to do a straight withdrawal from the credit union for this and avoid interest, or is there a benefit in taking out a holiday loan?
Okay, so you're going to take the money out of in straight withdrawal. I assume you mean take it out of your savings, or do I take a loan for that? I think is what they mean. So maybe they have savings in the credit union. They're wondering, should they just take it out in one go?
Or in terms of their credit rating.
Okay, so it's credit rating. Okay, I think I know where we're going here. Maybe it's the fact that you've been building savings up and you're worried about taking the money out, and then if you go for a mortgage in the future, they say, oh, look, you took money out of your savings. I would, if that's your concern, definitely take it out in one go, because then it looks planned. If you take a small amount of money out every week and try and hide the fact that you're taking 1,500 quid out over 6 or 7 weeks, you're going to end up, it's just going to be seen anyway. So take it out in one lump. It was planned and you take it out. In terms of borrowing money and your credit rating, like if you've got savings there, it kills me to borrow money when you've got savings, like particularly if you're going to have plenty of savings left over afterwards. And the interest, you'd be better off just topping up your savings for a few months and paying yourself the interest instead of giving the interest away to somebody else. So with a big caveat that you've plenty of savings left over afterwards, take it out in one lump, and that looks better than taking a small amount out regularly for the next couple of weeks instead.
Okay, so I'm buying a new used car in the next 6 months, but I'm also saving for my mortgage deposit. Should I use the savings to buy the car or get the car financed and keep saving for my deposit?
Okay, similar question to the last one. Similar question. So I suppose really, will I use my savings or will I get a loan? The loan is seriously going to damage your ability to borrow money, in terms of that when a bank looks at you, one of the things they look at is they look at the amount of money as a percentage of your take-home pay that you can afford to use on a mortgage. So in simple terms, imagine your take-home pay was €1,000 a month. Imagine that's what you made every month. 35% of that is €350. So what the bank does is they say, okay, this person takes home €1,000 a month. They've got €350 that we would say they can afford to put off a mortgage on a month-to-month basis. And then they work backwards and say, €350, that's our interest rate. We've got 30 years to pay it back, and that's X amount per month on a mortgage, or a lump sum of a mortgage. Now, if you've got that 350 there and you've 100 a month going out onto a car loan, now they reduce it down to 250 is what can afford to go on the mortgage. So a small car loan, or let's just make my life simple. Imagine the car loan repayment was €175 a month. They reduce that 175 off the 350, and you're going to get half the mortgage you would have got had you done it the other way around. Might be a slight exaggeration there, but you can see where I'm going with it. The whole point about it is it's the repayment of the loan that damages your ability to get the mortgage, not the loan amount outstanding. I would say to you, you're buying secondhand, delighted to hear that, but I would say to you, just for the moment, what I would say is if you can hold on to the car, get the mortgage first and buy whatever car you want after that, might be a better option if you can keep the car you're going in. Remember, when you trade your car in, someone else is going to be happy to buy it and drive it, so why aren't you?
Okay, there's obviously a car theme this week, so this is another one. So I want to buy a new used car. Is PCP too good to be true? I can't decide whether to take out a car loan or to finance it doing PCP.
Okay, so a new used car on PCP is going to be a fairly new used car, because PCP is generally for new cars, and sometimes you can get a little bit of an older car. PCP for me is not, I'm not a big fan. and I'm on record plenty of time as saying this. The problem with PCP is you walk in on day one and either you give a chunk of cash as your deposit or you give them a car that you own and that's your deposit. 3 years later, you walk back in again, and I had a friend of mine recently who walked in and they were told, oh yeah, all that deposit bit that you gave us, that's all gone now. And you need to give us another deposit to roll over into the next one. And this is a problem that could come down the line, and it is happening already, obviously, in that case. But the problem with it is the second-hand car market can go up and down, particularly with where sterling's at, how many cars have been imported. All these things can affect our second-hand car market. And the first thing to be taken off the table is the money, the equity, the deposit that you put into the car in the first place. That disappears first, and then they protect what they need to cover their loan. The reason why PCP is being pushed by the car manufacturers is because the loyalty you have to have from now on to that brand is massive. And they know if they can get you hooked on a PCP now, the likelihood of you changing to another car of their brand again in 3 years' time is much higher than if you were to get a loan. So I would say to you, ideally use savings. If you're going to get a loan, you're going to stick within the rules in terms of mileage and everything else, PCP might be an option for you, but accept that you're probably going to be with that brand most likely for the rest of your driving days.
Okay, so this is from Pauline. So, hi Eoin, would you have any tips to consider when selecting mortgage protection and illness packages for a mortgage I hope to buy early next year?
Okay, so you've got the mortgage sorted out, you're hoping to buy early next year, and now you're wondering about the life cover and the specified illness cover. Really important that you know that one of the things that we all do when we take out a mortgage is we protect the bank. So the bank will insist that you have life cover, because if you die, they don't want to be chasing your widow or widower for the mortgage repayments on a month-to-month basis, so they want the mortgage cleared off. And loads of us go out there, we get the life cover, and isn't that great? We've protected the bank. Specified illness cover is more expensive, but the statistics show us what specified illness cover does. Life cover pays out when you die. Specified illness cover pays out if you get a specified illness. Cancer, heart attack, stroke would represent 75% of the claims. Female claims are 75% cancer related. Male claims are about 60% heart attack related. But overall, cancer, heart attack and stroke make up 75% of the claims. You are 5 times more likely to claim the specified illness cover than you are to claim the life cover during the term of the mortgage. And you need to expect to pay for that. It's going to cost you about 4 times as much to pay for life and specified illness cover together as it would if it was just life cover on its own. So if the life cover on its own was about 25 quid a month, you need to expect to pay around 100 quid a month for life and specified illness. But just remember what you have now. It means if you die or you get seriously ill, a specified illness, the mortgage is going to be gone in full. It's just going to disappear. And that means you won't have a financial crisis at the same time as you're having a medical crisis. I am a strong believer in specified illness cover. One of the mistakes I've seen happen time and time again, you're going into a new mortgage, you've allowed for all the costs, you never allowed for the specified illness cover, and you say, I'll just take the life cover now, I'll satisfy the bank, and I'll come back next year when things have settled down and I'll get the specified illness cover then. Things never settle down. So just build it into your costs from the start. It's a great question, but build it into your costs from the start and make sure that you have, if you can't afford the entire amount, get some specified illness cover.
Okay, so the last question is, what's your opinion on the length of mortgage? I could afford to pay a 20-year one, but I'm being advised on a 35-year. Just an FYI, I'm a first-time buyer.
First-time buyer, I would say to you, now, if you've got someone holding your hand, if you've got an advisor who's going to hold you to task to make you do this, if we have a client in that situation, what we would do in private practice is we would get the longer term and we would pump the extra money. So the difference between the 30-year loan or the 35-year loan and the 20-year loan repayment, we take that extra money and first of all, we try and pump it into pension, or secondly, if pension's already maxed out, we put it into savings. Build the savings up. In 20 years' time, if you want to clear off the balance on the mortgage anyway, you should have enough to clear off the balance on the mortgage anyway. But what happens in the meantime is you have some money readily available to you to stop you going into debt, that you've got savings to call on if you need to. I just think it gives you much more options, and if it's extra interest you're worried about paying, do the maths. If you have enough in savings in 20 years to clear off the loan, you're going to save all that interest anyway. And you might decide life is different and you don't want to do that. So great position to be in that you can afford it over 20, but maybe there's a better use of your money than actually taking a lower loan repayment. But that's if you hold yourself accountable to making sure that you put the extra money that you have now on a month-to-month basis to really good use. And that's really important. So your call. If you trust yourself, go for the longer term. If you don't trust yourself to spend the money, go for the shorter term. It's really hard to go back to the bank afterwards and ask them to change it from 20 to 30 years. It's easy enough to go from 30 to 20. Or if you really wanted to, take it over 30 years and give them the 20-year repayment on a month-to-month basis, and then it's in your control completely. So hope that's useful. That's all the questions for this week. Thanks very much for listening in. We will be back, I think, next week for Facebook Live as well, and I'll be on Ciara Kelly on Thursday afternoon too.